Hi guys, welcome back to our channel. Please don't forget to subscribe and like. A lot of people are watching videos but they're not subscribing and they're not liking the video. It's quite discouraging. It will make us not do YouTube videos anymore. But anyway, let's get into it. Today we want to talk about smart money concept. This is Blue League markets. If your mentor is not teaching you the following, then I think you should get a new mentor because this is the way to actually trade. This is the um ultimate way to do forex. So if your mentor is not teaching you about things like order blocks, imbalances, liquidity, change of structure, break of structure, and all that, then they're not teaching you what they're supposed to teach you. So in this video, we're just going to do a short summary of how smart money concepts work and how we actually take trades using smart money. And we're going to show you some of the mistakes people make and they end up saying smart money doesn't work. But in fact, it does work. It's just that a lot of people do a lot of mistakes. So in this picture, as you can see, we'll take the yellow line as our 4 hour, then we'll refer to our white line as our 15 minutes, then the red line will be our 5 minutes. So I'll explain using that. But before I explain a lot of things, I just want you to understand what imbalances is. So imbalances happens when a candle, let's say first candle, let's say the market was moving in this direction, um, then it decided to push to the upside. So if it happens that the market prints out a candle like this, which is an engulfing, retail traders they call it an engulfing candle, then prints out another candle like this, then a third candle like this. Now as you can see that the wick between the first candle and the third candle didn't touch. This leaves imbalances in the market, and regardless of where the market goes, the market has to come back and fill this imbalances. Now this market imbalance, now imbalances goes a long way, but we'll explain that in another video, or you can take part in our mentorship. We teach all of this, imbalances, liquidity, and all that. So in this picture, as you can see, the market was moving, printing high highs and lower highs, and it was in an uptrend. um it was going in an uptrend. So what happens is the market came and broke structure. This is break of structure, and went up to print a minor structure. We call this a minor structure. Let me highlight it so you see it. This is a minor structure, and this is very important. I'll explain later on as we continue with the video. So this is a 4 hour. The first thing you do when you're trading smart money is you need to go to your 4 hour chart, and you need to see a break of structure. So after that break of structure, it created a minor or an internal structure, then went up. But when it got to its highest high, we can say that's a swing high, it started going down. So you change to your 15 minutes chart. You want to see price going down and actually touching your 4 hour POI. So that's what you want to do. But as you can see, it's not like you have to wait for the price to come and touch the 4 hour chart in order to take trades. You can actually take trades and check the market as it goes down. Sorry about that. So a lot of people, as the market is going down, it starts making structures. As you can see here, it broke structure. A lot of people will take trades and say that since it broke structure there, they would go to that point of information of interest there. Then they would take a trade, limit their stop loss, then they would target this order block, only to be taken out the trade there. Now, let me explain why that happens. So as you can see that the market is making internal structures and it's breaking internal structures. The only way you can trade this to the downwards is if the market breaks this internal structure it printed on the 4 hour chart. So this will be used as liquidity. So you have to wait for price to break this internal structure and print out a change of structure. Then this change of structure, it will go back and take orders from your imbalances which happened when the market starts moving down. You're not supposed to take any trades here, because the taking trades here would be very, very dangerous, because the market will sweep all this liquidity in order to move down. So if you wanted to trade this going down, we're supposed to take a trade in that um POI, which is here. Sorry about that, which is here. Then limit your stop loss, then take your profits there. This is how you trade. But a lot of people make a mistake of trading internal structures, internal break of structures, and they think that's what you're supposed to do. No, you're not supposed to do that. You should wait for market to break an internal structure, then wait for it to reverse and take the orders which were left there by market makers, then move down with the market. So as you can see, the market went down, created some sort of liquidity, double bottom liquidity, then it went down to sweep all of that. It continued taking orders, then it created a range. Market likes creating a range next to the order block it has to touch. So it created a range. The reason it creates a range is that it wants people to start taking orders. As you can know, retail orders, they buy low and sell high. So when the market gets here, they will sell. When the market gets here, they will buy. So that's what they do. So the market is preparing people, it's inducing people to taking buy orders there, sell orders there, and at the end of the day, it will sweep all that liquidity and continue what it does. We're not going to give the full explanation to this now, because you want to keep this video short. Then afterwards, immediately the market touches your 4-hour point of interest. What you need to do is, like I said before here, you need to avoid taking trades when the market is busy breaking internal structures, because this will be dangerous to your trading. Because at the end of the day, the market has to come down after breaking the I can say it's your swing high in the 15 minutes. So you need to wait for the market to break that swing high and come back to take your trades in the 1 minute point of 5 minutes order block. So you need to avoid taking trades here. You need to avoid even taking a trade here, because this is called inducement. It just wants people to think that, okay, now it's breaking structures, it's taking orders, and which is the wrong way to do it. You need to wait for market to break that internal major swing high or swing low, and wait for the market to come down and take your orders. So this is how you would trade this. You would wait for it to break that point, then you would go and find your point of interest or your order block, limit your stop loss. Usually when you're trading smart money concept, your stop loss is usually 5 pips to 10 pips. Is never bigger than that. Then take your trade. So where do you target? You target your swing high, your 4-hour swing high. That's where you target. Now, why do you target that? You target that because since the market came and broke the structure, then went up and printed a new higher high. This higher high becomes a weak higher high because it failed to break this low. So this becomes a weak higher high. So in order for since the market came to this order block, it has to break that high, because that high becomes a weak high. Retail traders would say because it touched a trend line and something like that, which is not really what the market does. You should trade like how you should think the way these guys think in order to understand what happens in the market. But anyway, let's leave the video here. We just wanted you to understand this picture. If you can understand this picture, then you would trade smart money easy and you would make profit with your stop loss being limited. Anyway, please don't forget to like, comment. If you have any comment or any question, we are happy to answer your questions. And don't forget to subscribe. Like, guys, subscribe. And those who want mentorship, you can check in our description. We'll leave our email address there. You can contact us, then we'll see where we take it from there. Thank you guys for watching.